And everybody, it's Tim Reazor with Revere Asset Management, just after 5 o'clock here on a Wednesday night. So very quickly, StockNerds and Market Lovers, before you and I begin, the podcast is done already for the week, in the can and out there, sent out via email, socially to the world. This is one of the best shows we've done, and we've done some really good shows of late. And that's not me pandering to me. That is me telling you that I really think you can get a lot out of this show. And the words how to maximize your 401k, do not be fooled by just that title. There's fib work in here, Fibonacci work in here. There's a whole bunch of strategy in this video, or this podcast, this video podcast. So you can get it Apple, the iTunes store, you can get it on the Google Play Store, delivered right to your device, or you can come to the Revere Asset webpage and play it right from here. If you get it in your email, you know exactly what I'm talking about. The video plays, the production quality is amazing, and so I think you're going to like it. And look, tonight's video, I'm going to talk about earnings runners, how to find what an earnings runner is, how long an earnings runner can go. We're going to talk about the markets, and the one chart I think you need to be following to make a determination of where this market could be truly headed. Okay, so we'll do that, but before we do all that, listen, let me introduce you to the team here. So Hunter, Alex, Don, there's myself and America's fiduciary, Danny Stewart. Listen, any questions, concerns, comments, take umbrage with anything that I'm saying. Now listen, you send me your questions, and I greatly appreciate that. You can find me at TJ Reazor on Twitter. That's literally at TJ Reazor, spelled R-E-Z-O-R. You can DM me right there. That would be awesome. Or you can email me right here. I answer to both. This one, the Twitter one, is a lot quicker because you're limited to characters. That is brevity, and that's why it goes quicker. So listen, 855-732-5932. Any questions on the portfolio strategy, what the fellas are buying, what they're selling, why they're buying, why they're selling. The difference that our shop and every other shop in the free world, the difference between the two, or everyone else and us, is that we're accessible. That's such a big deal. Now you're talking to strategists, you're talking to people that actually make the decisions. What everybody else in the free world does is they have plausible deniability. So you go into stripmalladvisor.com. Stripmalladvisor.com says, well, I don't make those decisions. I don't really know where the market's headed. Let's get on the phone and we'll call the portfolio manager. You think you're actually going to get the portfolio manager for a mutual fund that you're in? No. And so therein lies the issue. We don't do mutual funds, or the only time we ever do mutual funds is when we're limited by someone's by individual investors' 401k. You're talking, we're doing stocks and ETFs here, folks. So email the portfolio team right here, have at it. Email America's Fiduciary. And I'm gonna tell you something, all the things that other shops charge for, we do for free. When you become a client of the firm, you're a member of the family. And so life planning, maybe there's a birth, unfortunately, maybe there's a death. Things that we think you should be aware of, processes that can save you tens of thousands, if not hundreds of thousands of dollars down the road or immediately, we know about. And Danny is a pro. He's one of the best in the country at this. We don't sell any of our services other than a strategy. Everything else is included. We don't feel the need to nickel and dime you like everybody else and their brother in the free world. So 855-732-5932 is how you do that. Okay, so with, oh, by the way, in the podcast, I do a lot of talking about the 10-2 spread. It's very interesting. I make it interesting. I was interested when I was listening to it or doing the research for it and bringing it to you. And if I'm interested, I always think StockNerds and Market Lovers, there's like a 90% chance you'll be interested too. And so hopefully the context to which I bring to that discussion is illuminating. It helps you make or save yourself a boatload of money. So let's look here, what I'm seeing in the markets. As I take a sip of what I think is the second most important cup of coffee, it's the evening cup of coffee. So look, I think what you have right here is the little June scenario. And so you've got these 2 days, testing your courage of the markets. And look, we got these 2 days testing your courage of the markets. But look what happens just a little bit later here. What happens a little bit later? Yeah, you come back down again. Now that is in May. Now here's June. June, you get this test, but you don't come back and you just go. My thought is that you might be in like a maze type scenario. That's my thought. Do I think it's going to fall apart, hell in a handbasket? I don't know. It's a market. Clearly anything can happen. But this to here so far just looks like June. just, okay, 2 days, shake the loose leaves off the branches of the tree, and then we keep moving. We'll see how it plays out, but there's a couple charts I think you should be aware of. And by the way, let me build upon what I talked about in yesterday's video podcast. So here is the hourly chart, and you can see I got the fib retracement high to low, and we failed. Like if you look at the Nasdaq here, we'll put the Nasdaq up on the hourly. So last week on the podcast, talked about how we failed right at the 618 retracement, and down she goes. The exact opposite is true here. So when you surge through the 618, there's a great chance you go to the 786, come back and retest, and you can see the retesting, and now you're up at this new level. This is a 786 retracement, or beyond this. Yeah, it's a 7. You know what? I've got too many levels. So let me take this level off. I can always redraw it. So we'll remove it. There we go. So you're beyond the 786. You're between 786 and 1272. Do you get to the 1272? I kind of don't think you do. That's just me. That's a big gap, a big gulf there. 786 will probably come back and get retested. Now, do you come back to the 618? I don't know. Like that's too micro for me right now. What I know is that when you press through these levels with such strength and determination, you're going to go find the next level. But what was today, I think, really predicated on a couple of things. So the first one I want to show you is the dollar. In the podcast yesterday, I talked about the dollar and how it's not giving you any signs. But let me show you the dollar on a 5-minute chart today. Today, the market was driven by the dollar. And so here's Wednesday at 7:20, right? And now we're going, just look at the chart here. Here's 8:35, and the dollar comes off of its highs and really kind of finishes towards its low. Okay, so today's Wednesday, and you can see the dollar had gapped up, right, from yesterday, and now here this morning when it starts trading, and then down lower. And if I put a chart of S&P futures up here at the 7 o'clock time frame, you can see how the market was coming lower, kind of comes up here. The dollar opens up, if you remember the chart from just 2 seconds ago, and then as the dollar's coming down, what does the market start doing? Going up, right? And so we'll just isolate this 7:45 to 8 o'clock time frame. So I'm going to isolate right here, 7:45 to 8 o'clock time frame. Now let's go back to that DXY chart, DXY, and we're going to isolate that 7:45, 7:30, 7:45 to 8 o'clock time frame, and then the dollar starts to fall, and then the S&Ps go what? We've only just begun to grind. Yep, they're grinding higher. And so huge inverse relationship today with the dollar and the S&Ps. But I want to show you this chart of interest rates, the 10 years. And so a lot of research for me on the 10-year treasuries. Oops, excuse me, TNX, not Texas. So TNX. And so when I'm looking at the TNX on a daily chart, we'll zoom in here. You've just come up to this trailing, the green dashes here are the trailing 8 period. So you've kind of paused there. And so there's a couple things that I want to point out to on a daily chart here. If you were, now could treasuries gap, could yields go higher? And look, the market clearly likes this. Yields are expansionary. Yields are the economy's okay. So yields up, markets up, right? Okay, and that's kind of 2 days of that, right? Where yesterday you kind of pegged lower but closed at the high, and then yesterday was a good day. Today is a good day, right? So that, and then here's the gap lower on Monday and yields down, markets down. I kind of think that's what you're seeing now. And so what's interesting to me here is a couple of things. One, so if you're saying I want to go long yields, I think yields are going higher. I think treasuries are coming lower. Now treasuries might come lower, meaning the prices of bonds might come lower. Hard to say what's going to happen here, but if you were, going to say what is the path of least resistance, I encourage you to do this little trick. Take a minus sign, put it in front of any ticker in Thinkorswim, and then hit enter. And so if I showed you this chart, it doesn't matter what it is. If I showed you this chart again, it doesn't matter what it is. And I said, hey, it's pulled back to the 8. If you're an aggressive trader, this you could be an entry. Maybe you'll wait for a pullback to the 21. This is a bullish chart, and the path of least resistance is in fact higher. What's interesting to me here is that we've inversed the chart, and so we're going to do it again. this is the way the chart really is. And so now what we have here is a chart that is heading lower. And so the path of least resistance, in fact, could be lower. And so when I look, now I want to drill down. In the lowest time frame, I kind of like to do, especially with you guys on the videos, are hourly charts. And so, you know, if you take it down, and I say that because the chart you take the trade off of is how you have to manage it. And so just like that Nasdaq that failed at the 618 last Friday, look at what the TNX does. And this is good enough for me for government work. It kind of stops here in that zone of a 618. And so on an hourly time frame, just like the Nasdaq did. And so my thought is this: if, and it's a big if, it doesn't have to happen, if the TNX were to come down lower and just do a half-back retrace or try to retest these lows here, does the market get soft again? Do the algorithms trigger, oh, low yields, slowing economy, sell stocks? And is that really the path that we're on? And so interesting to see. But again, on the bigger picture, the TNX, the 10-year treasury yields, and by the way, the yields right now are just 1.28. So 1.28 is the yield right now on the treasuries. And so that is a far cry from where you were earlier. Gosh, just earlier this spring, like, we look here, just a little while ago. I mean, this is wild trading, like 1.4. I mean, just craziness. This is a ton of volatility for the bond market. The bond market doesn't usually project this much volatility. It's why I'm kind of bringing it to you this evening. But now to the star of the show: earnings. And so let's take a gander here, folks. So there's something that keep you out of trouble pre-earnings or prior to earnings, and just any time, right? And it's the 3 ATR. And so I'm a big fan that stocks, markets, commodities, they all trade within a range. So let's get this to a daily chart here. We'll keep TNX up. Doesn't matter what we keep up here. Let me see if I can. There we go. And so look, you can see earlier in the year, back in March, TNX hits the 3 ATR and you start this pullback, right? And so if you're of the belief that when things hit the 3 ATR, you can do a couple of things: trail up a stop. Somebody asked me this question, so I'm going to cover it. Or you know, you start lightening your load. Maybe you sell a quarter, sell a half, and then when it starts to break the 3rd ATR to the downside, you just let loose. But when things hit this 2nd and 3rd ATR above the mean of what? Above this, the 21 exponential moving average, that is a graphical representation of overbought. So someone can say something's overbought, but if you want to see what true overbought looks like, look at the chart and see where you are. And it doesn't mean you have to stop. Just because you come to 3 ATR, as I'm going to draw right here, doesn't mean forward progress stops for a stock. What you can do is you can trail up stops. So let's say you bought whatever it is off the mean here. Well, that would be day 1. And as long as you don't close, say, below the mean, you're in. But the further you travel, so let's say it's 1, 2, and 3, go back to this day here, 1. Did you close below the mean? No. So now day 2 becomes your 3-day bar. And so do you close below day 1? No. Keep traveling. And so you erase that. Now you can see 1, 2, 3. You just got to keep traveling up your 3-bar stop. Look back to that quote unquote first day. And if you don't close below that low, you're still in the trade. Hopefully that cleared it up. If it didn't, and I just kind of did that quickly, and hopefully I didn't cause any more confusion, just email me, tim@revereasset.com, or @TJ Reazor on Twitter, and I'll try to clear it up a little bit more. But remember, in the markets, the more precision you try to have, the worse you're going to do. You're playing hand grenades, not horseshoes, okay? So as the song says, hold on loosely, okay? So that's TNX. But look, let's talk about some earnings trades and move this show on really quick. We can look at Amazon, okay? And so 3-bar trailing, 3 ATR works really well with stocks like Amazon for some reason. They work well with all stocks, but in particular Amazon. So Amazon 3 ATR pulls back, 3 ATR pull back, 3 ATR pull back, 3 ATR, yeah, go a little bit higher, but look at how far you pull back. Does that mean you have to sell it? Well, I'm a long-term holder of Amazon. I've never done anything like this. Well, if you're a long-term stock trader, you trade your plan. Always defer to your plan, your plan, your plan. the way I come across on videos and the way I talk to stock nerds and market lovers comes from my years of experience of talking to you in person. And I haven't met the trader that's established a position that is willing to give up the gains in the name of long-term. And so 3 ATR gives you a graphical representation. 2 ATR of, hey, maybe getting ready to take some profits, getting ready here. Of course, you got earnings coming up. And so, by the way, look at sticking with A's, this Apple to a core, right? Apple to a core, didn't even try to make that joke. And so 3 ATR pullback, getting the government work zone of 3 ATR pullback, 2 ATR pullback. Just riding that rail, 3 ATR. Oh, but Tim, go higher. How about a 3-bar stop, 3-bar trailing stop? You could do that. And now you've got earnings coming up at the end of July. And so do you have to trade out of Apple? I know the course is of just own Apple, don't trade it. Whatever you want to do, whatever your plan is. I'm just pointing out the ebbs and flows of the markets, and you trade them how you see fit. Roku does this, ROKU, I believe. Yeah, Roku does this a lot too. You can see Roku, 3 ATR in the zone here. Oops, did not mean to change the ticker box. So let me just get out of that. Roku, yeah, 3 ATR, and you can see 3 ATR. Okay, what about earnings? Let's talk. So when you get earnings, and let's think of a stock. Oh, Chipotle. Chipotle had just a magnificent, again, 3-bar trailing stop. But look, it pulls all the way back to the mean earnings, and then boom. So how long can this last with Chipotle? How long will it possibly last with Chipotle? Well, when you get these kind of gap ups, they typically last, I'll give you 4 to 7 trading sessions before they either pause or pull back, if not to challenge their gap. And so I always tell folks that want to strike up a conversation about this topic, there's no need to ever chase. Never, ever is there a need to chase in this regard. And so I always say prove it, right? And so here, we'll just go back a little bit with Chipotle. Are there any gap ups in Chipotle's earnings that would, I don't see anything on this chart that stands out to me. So let's go to, I think Facebook is a good one here to look at in this regard. So let's get on a chart that you're used to. A 5 and 8 to 21 moving average. And look, here's a great example of this. And so Facebook, look, gaps up. It gave you a couple days and it pulled back. And yes, did it absolutely go higher? But you don't have to jump right in. That is my point here. You can give it time to come back to an 8 exponential. Find yourself an entry that makes sense for you, okay? And that's the whole point of this. You don't have to rush in anything. Here's another one, another example. Gaps up, and then it spends 3 days there, 6 days, and then it really pulls back. You're going to find an entry that makes sense for you, whatever your trading style is. If you just want to establish a position and then have at it, don't look to me to justify what you want to do. Look to me to show you that you don't have to rush. And so you can look at, I think, Snap. Let's just look at Snap. Snap has done this a number of times, I believe. Yeah. And look, Snap is clearly, on the march from last October, right? And so gaps up right here. I mean, this is a mid-30s stock, and now you're trading, $63, $64 a share. Comes up, eventually you come down to the 8, but look, this one stayed, it finally comes back to the 21. I think the 21 is your best entry. But again, don't take anything that I'm saying as advice. These videos are never advice, never to be misconstrued advice. One advice, anybody, I need to call 855-732-5932. But this is a patience game, right? So you get 1, 2, 3, 4, 5, 6, 7, and then you pull back to the 8 period exponential moving average. Accelerate, right? You think you missed it, and then you get to the 21. And look, all you did was come back to like that day 2 level. There's nothing you're missing in markets. It's open every day, and there's new stocks. You just have to be able to screen for them, have some rules to come out and find them. And so Snap would have been a hard one, right? If you're like, I should have gotten Snap, and it's real. I mean, this is like 2 weeks of trading, right? 5 trading days a week. And so before you get an opportunity, and yeah, it takes a little bit of patience, but I think patience are what's rewarded. And so like RH does this. Let's look at RH. And so let's find an earnings. Here's an earnings gap up with RH, 1, 2, 3, 4, and then it pulls back to the 8. And like, well, then it went all the way up to 733. Yeah, a little bit higher here, but if you're really aggressive, trade the 5, I guess. But I kind of prefer to watch for an 8, and because historically these things are going to come back. I know, like right down here. So here is the big gap up, right? And gaps up and then spends 1, 2, 3, 4, 5, 6, and then it starts to break. It's over a week, right? And, but you can't catch, when you go swimming, you don't touch all the water or get out of the, and you don't just touch that little finite area of the pool or the ocean or the lake or wherever you're at and go, God, that sucked. I needed to touch all the water. No, you're going to miss some trades. And I think being okay with that is really a valuable mindset. Let's look at, let's see what else does this. Maybe IBM. Let's see. Does IBM do this to you at all? Yeah, sure it does. So IBM, I knew I had this in my mind. So IBM gaps up. Look at all this time it spends, and then finally it breaks. But it comes all the way back to like day 2 levels. Just got to get them on your radar. I don't particularly think you need to buy them right away, unless you're a short-term trader. If you're that short-term trader, you're trailing up your stops and you're just in there to get a couple of days worth of gains, or you're selling put credit spreads, or you're doing some strategy that works for you, then, man, I get it. I know why you're screaming at your computer that I don't know what the hell I'm talking about. I get it. I totally get it. And so let's look at one or two last things here. So what's interesting to me here about earnings season is understanding when earnings are being reported. And so you can do that just by implied volatility. Of course, the dates on the charts for Thinkorswim, a number of places to find that, but look at the implied volatility. 41% for the rest of this week, almost 74, 75% for next week, and then it starts dropping off. So what do you think? When do you think Tesla's reporting? Tesla's reporting next week because it's an unknown event. And so when those binary events occur, the market makers increase the implied volatility dramatically to cover their arses. So they sell, so the calls and puts that you buy are marked up substantially. That's why, the house always wins, man. The house sells. If you want to, and by the way, selling a put credit spread leading up to earnings, I don't think is the answer either, because the implied volatility keeps going up. You want to sell a put credit spread and something like at the money, because you're going to get the IV crush or the implied volatility crush, meaning it just fizzles away. Then absolutely that makes sense to me. But buying calls or buying puts into a truly binary event makes no sense to me. But to each their own, and there are people that teach that strategy. Like, let's look at Netflix. So Netflix, by the way, if I could go show you back in time, and I wish I would have taken a screenshot. Netflix had a $28 expected move. That means plus or minus 28 up, 28 down. Look at what it did today. Yeah, kind of right in the middle. And all that's doing is bleeding off. Like this IV was like almost twice this. It's just bleeding off that IV. Doesn't make it good, doesn't make it bad. It just means that people who get crushed, the people that are going to lose money, are the people that bought calls and the people that bought puts. Like, well, too, it was down 3.28%. You paid more for those puts, right? And so the market makers charge you more for merchandise when they don't know the outcome. And you're like, wait a minute, it's a market, Tim. Nobody knows the outcome. Au contraire, my friends. So the market makers are selling options in a range, and about 70% of the time, if you can draw a bell curve out, you're looking like this is statistically about that the calls and puts are going to fall, like for next week, are going to have, when you start trading next week, like a $20 range, 68% chance. Okay, it's like a 68% chance. That's what the math figures out on the bell curve. And so, yeah, you just kind of want to understand all that, or do some research into all that, because what happens is every now and then, one of these will exceed your expectations, like a Chipotle, right? Like Chipotle, is Chipotle going to be a runner? I mean, it was up 10. Yes, Chipotle, that is a runner, but it's going to give you an opportunity, so there's no need to chase. That's the whole point. And so just understanding that means that you don't have to. I mean, think about somebody who bought puts on Chipotle oil. Well, of course, they just went to zero, but some bought calls. They hit the biggest home run probably of their trading career, right? That is really tough to do. And so consistently. And so if you're bullish on something, I always say sell maybe put credit spread right at the money, or do an ion condor for the expected move, and that should wet your whistle enough. And always small size. And so hopefully that helps. Hopefully this was informative. That's the whole goal here. A little bit of entertainment, but a lot of information for you to help you grow. And any questions? Your questions make me better. Feel free to send them to tim@revereasset.com. With that, hope you have a great night, and I will see you at the next update.